Okay.
Very good evening, everyone. Am I audible, sir?
Yes, you are audible.
Very good evening, everyone. Today, I am CA Sarika Deshpande Dindokar welcomes you all for a webinar on share market and technical analysis organized by Pune branch of ICAI. So we have today with us our CCM Chandrasekhar Chitale sir and CA Amruta Kulkarni, chairperson of Pune branch of ICAI. So to start the session, before starting the session, now I request CA Amruta Kulkarni to give welcome address to our today's session speaker.
Thank you, Sarika. At the outset, I am really thankful to Chitale sir for coordinating this particular, rather suggesting us that we should have a series on such a typical event. And we are really grateful to CA Archit Dole for sparing his valuable time, and he will be sharing his insights and the technical analysis on the markets. I'm also very much thankful to all the participants for joining in on this session. I recognize the presence of the past chairman of the Pune branch, CA Rajesh Agarwal. I can also see Sarvesh Joshi sir, former WIRC vice chairperson, who has also joined for this webinar specifically. And taking this session ahead, I'm sure Archit, with his analytical skills and the insights which he'll be sharing, will be of great help to all the participants, those who have joined in. And requesting all the participants to please share your feedback as well as the suggestions in the chat box. The Q&A would also be open. And over to you, Sarika, for the further navigation of the session. And I recognize the presence of all the participants, the present and past leadership, as well as those who have joined for this particular session. Thank you so much.
Thank you so much, Amruta. Now I request CCM Chitale sir to give
Service, let's service talk first.
Now I request CA Sarvesh Joshi sir to give his opening
Sarika,
remarks.
Sarvesh sir also has joined.
Yeah, yes. Sarvesh sir, are you there?
Service is member of
Can you hear me? I have a very limited range. I have a limited range. Can you hear me? Hello.
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 So today we have CA Sarvesh Joshi sir with us. Sarvesh Joshi sir, can you give your remarks?
Some technical glitch at his end. Sarvesh sir is... Yes, Sarvesh sir, now we can see you. Sarvesh sir, we can't hear you.
Yeah, we are not able to hear him.
I have a very limited range for here. You all go ahead. Can you hear me?
Okay, sir. Yes.
Please, if
I think
Service got disconnected. So okay.
Yeah. I think that because of technical glitch and range issue, Sarvesh sir's voice is breaking. Now I would like to ask CCM Chitale sir to give opening remarks before we go ahead. Sir, please.
Yeah. Thank you, Sarika. We are indeed very happy to have Archit with us for this particular session of share market and technical analysis. As friends, you are aware that last week Pune branch had seminar on capital market, and it was particularly relating to investment and trading in shares. So much was discussed about technical analysis, but that was high funda. So members requested that let us try to understand basics of this technical analysis, because this helps in investment. And as a chartered accountant, maybe we are engrossed in doing auditing, rendering services, taxation. But as we are aware, in case of agriculture, we always recommend the agriculturalists that, okay, besides agriculture, maybe you can have one another stream of income. Maybe you can have cows, you can have other hens and other things, so that it will supplement your income. Similarly, in case of chartered accountants, now I believe that for chartered accountants also this supplementary stream of income is necessary. And for a chartered accountant who behold some surplus, it may be criminal for them to invest in bank deposits at 4%, 5%, because they have all the knowledge of stocks. They have formally trained about the corporate laws, about the balance sheet. They are able to read the financial statements, read the director's report. So what holds them in making investment? So they should make investment. While making investment, it is not just making investment for the sake of investment. The money should work for you. And in order to fortify your returns, it is necessary to understand some other techniques of investment in stock exchange. And technical analysis is one such technique. Now, one can read books and understand it. To what extent one understands, one doesn't know. But we have Archit, who is an avid investor and trader in market. I am not aware whether he has earned in lakhs. And if I'm making error, it must be in crores. But he is very at home as far as his technical analysis is concerned. And he himself, by using this technical analysis, is dealing in the stocks and investments. So we are very lucky to have him. He is from Pune, but presently, on account of his occupation, he is settled at Hyderabad. So from there, he has joined. So thank you, Archit, for really agreeing to share your insight into this particular subject. And I'm sure that all the audience would be very benefited. Today, there may be quest for their brain, but maybe in coming days and months, it will also satisfy the quest of their pocket, and maybe they will be able to reap harvest out of the tips that they will receive today. Thank you and welcome.
Thank you so much, Chitay sir. You have truly said that your money should work for you. So indeed, this is very important topic, and I really congratulate Pune branch for taking this topic. Now I would like to introduce CA Archit Dole. CA Archit Dole is CFA level 2 and FRM level 1, currently working in US-based hedge fund since past 2 years. Prior to that, worked with Global Investment Bank in leveraged finance, swaps, and revolver lending products for roughly 5 years. Co-authored the revised edition of ICI publication Investment Avenues and Investor Awareness. He is a speaker at multiple forums and an inquisitive student of technical analysis since 8 years. So we welcome you, Archit, for this webinar. And I also request you to start a session.
And before Archit starts the session, one good news for all the listeners that there is a poll which is coming up where it is stated that BJP is getting 350 plus seats. So I think good days for market maybe on that. Archit would be a better person to comment. And with this, let us start.
Definitely. I think good day for the market on the Monday. Thank you so much for having me, Chitay sir. Thank you so much for that generous introduction and those insights. So Chitay sir, Sarvesh Joshi sir, Amruta madam, and all the dignitaries of ICI, thank you for inviting me. It's always a pleasure to be here and talk about a subject which I'm very fond of and have been studying since quite some time. And for the attendees, thank you for being here on a Saturday evening. I hope to make your Saturday evening sacrifice worthwhile. So with that introduction, I'll get started. I'll share my screen. Before I start sharing my screen, I would like to make the standard disclosure that since I work for a hedge fund, I may have access to some material unpublished price sensitive information. So reference to any stock index or any idea is purely for educational and study purpose and not a recommendation as such. I'm representing myself here solely and do not intend to represent my firm in any manner whatsoever. So with that standard disclosure, I'll share my screen and we'll get started. Let me know when you're able to see my screen.
Yeah, we are able to see.
Your screen is visible.
Perfect. Okay. So let's get started without any further delay. Um, what I intend to cover is the basics. So basics of technical analysis, or why technical analysis, does it even work? Because before we apply something, we need to be absolutely convinced that something works. Just like in case of a diet, right? I mean, we need to see the results first in somebody else before we say, okay, I'm going to follow a particular diet. So same is the case for technical analysis. So I'm going to talk about that as well. Then I'm going to talk about the building blocks of technical analysis and come to building a system using technical analysis. I had initially planned to keep these two separate, but because I thought I should be covering more of a practical approach, I'll be taking you through the building blocks while I explain how to build a system. Because technical analysis is just like any other sports, it needs to be learned on field rather than in the classroom. So with that, I'll get started with what is technical analysis. And I hope you're able to see my screen. It's a weird looking screen wherein you see some rainy clouds over a city, some dense clouds, of course. So it might be amusing to a lot of you that why am I showing this picture of dense clouds, rainy clouds? Because I'm going to ask you a question that, looking at this picture, how many of you think that it's going to rain in the next 10 minutes? Or rather, let me flip my question. Um, if I ask in the room that when do you think it will rain, looking at this picture, I'm sure we'll have minimum 8 to 10 answers. Somebody might say, okay, I think there is a dense layer right at the bottom, so it might rain in 5 minutes. Somebody might say, okay, there's a nice gusty wind, so these clouds just might fly over us without any rain. So minimum 8 to 10 answers is something we would expect, right? But now what if I tell you that the cloud ceiling is 1,000 feet, the wind speed is 8 kilometers per hour, expected to slow down to 5 kilometers per hour, and the temperature is 30 degrees Celsius. Now we have some data points to talk about. So we are not just looking at this pattern, we are trying to look at the data points from this pattern. And if I tell you that historically, whenever these conditions have existed and whenever the wind has slowed down to 5 kilometers per hour, in 8 out of 10 instances it has rained. Now, is that a formidable data point to make a high probability conclusion? Yes, I think indeed. Similar to how these data points can be used to assess when it will rain, exactly, ladies and gentlemen, technical analysis is something that will be used on the data points of stocks. So similar to this cloud picture, right? If I want to show you this picture, does this make sense to anybody? What is this? These are the prices of a particular stock from 1st of December to 6th of May. This is just like the cloud picture that I was showing you earlier, right? This is just some kind of numbers, number data, which is from December to May, as I said, but it's very hard to make inferences out of it, make conclusions, decisions out of it. When we are as a participant in the market, what are we essentially trying to do? We want some help regarding when to buy, and we want certain help regarding when to sell. But this data series clearly doesn't help in providing that guidance on a recurring, on a consistent basis. This is where technical analysis is going to help us. Now, let me show you the data that I was showing you earlier with a chart. Now we are talking, isn't it? The data that was plotted from December here, it's from this period. This is the data that we are seeing in the table. And when it was transformed into a graphical illustration, I'm sure just by looking at this chart, right, even without we talking about the details, even we talking about the nuances of when to enter, when to exit, there are a lot of observations that you might be seeing just by looking at this
Chart
chart.
is not visible. Chart is not visible.
Okay. Is it now?
No.
Is it?
Yeah, now now it's visible.
Yeah, okay. I think that was kind of hidden, but now I think it's visible. So I was talking about this period. I was talking about this period. So this is the period I was earlier showing on the PPT in a table, and when it's represented in a chart, just see the beauty of it, right? I mean, as I was saying earlier, I'm just repeating for the sake of benefit, since it was not being displayed earlier, that just see that there are so many kind of inferences that can be drawn. So usually we say that a picture is worth 1,000 words. I personally think that with technical analysis, a picture is worth crores, or if not crores, worth lakhs, definitely, if somebody is able to get that skill right. So just like, to summarize, just like the clouds, just by looking at the cloud pattern we couldn't infer anything, and adding some data points and looking at some historical patterns, we were able to conclude that there's a high probability that it might rain in a while. Technical analysis helps us do with the data series for markets. I'm just referencing stock here, but this is something which can be technically done with any data series, right? So coming back to this example, right, and moving to the conclusion I was making, that the technical analysis finally helps us answer that what is the trend of the price. So coming back to the point I was making earlier, that as a market participant, what I want to know whether the price is likely to go up or not. If it's likely going to go up, what is the optimal point where I want to buy? Now, I'm going to talk about only from an investor's perspective. I'm not talking about shorting at this point of time. So what is the optimal point for you to buy? Of course, it's going to be the point from which there's a very limited downside, right? So if I'm buying something at 100 rupees, I do not want the stock to go beyond, say, 98, or lesser the better. Yeah. So it helps us identify that what could be the optimal point, and if that optimal point does not fulfill, or it goes below the optimal point, we can simply exit the trade, right? So it helps us give a methodical approach to the random data series that the market is. And I always think that just like for any business, you need a structured process to run it on a continuous basis to get the results that they give. It helps us decide a particular system that is methodical, that is logical, and that can be run on number of trades to help us give the benefit of large numbers, right? So it really kind of transforms something which looks very abstract and very random to something which is methodical and rule driven, right? And when we do things which are rule driven, they of course give results over a large number of trades or a large number of periods. With that, I would like to sum up that it's a forecasting technique using historical price data that uses chart patterns and indicators, right? So it's using historical price data points to forecast what would the possible trajectory of the price could be, and that's done using some of the patterns which is it's analyzing, which we'll talk about in the next slide. Now, if I want to talk about, does technical analysis really work? Right now, I was talking about the diet earlier, right? So we need to see some successes before we are really convinced that, hey, that really works. Okay, so there are a lot of success stories on the market, but this one is which I found out to be absolutely mind-boggling. A trader made 29,000% in 2 years, right? That's from, I think, that the dot-com boom. This is definitely an outlier, and I do not want to project that this is something which is possible on a recurring basis. Absolutely not. This is definitely an outlier, but this person who is a known technical chartist. I'm just trying to tell you the amount of potential that technical analysis technical analysis has if you get the skill set right. Apart from Dan Zanger, there are a lot of known technical chartists, or rather known investors and traders. Mark Midivani, I'm sure most of you would be following the US Investing Championship, which is kind of a competition which is held on an annual basis, a lot of the chartists, a lot of the winners have come forward and admitted that they indeed practice technical analysis and are core technical chartists at heart. So it's not a hidden secret that it kind of really works. Now, if something really works, right, there's a common follow-up question to it, is that why does technical analysis work, right? So let's come back to the chart. Okay, now I want you to kind of visualize that market is kind of a giant auction. Okay, now if I want to give a comparative example of an auction, I think the best example could be probably the IPL auction, right? And what happens in the IPL auction? So let's look at it. So let's say we are into the IPL auction and we have some data points for it. Let's say a player starts their bid at 20 lakhs. Is my screen visible? I just want to double check since I switched to a different presentation, a blank presentation.
Yeah, we can see the screen.
Perfect. Okay. Let's say a player has a minimum bid of 20 lakhs. Two teams jumped in. They took.
Which screen you want to use? It says, why does technical analysis work? Is that the screen you want us to see?
No. I'm presenting a different PowerPoint. Let me see what's wrong. Oh, okay. Let me actually get on with presenting the entire screen. I think that should help because I'm presenting programs, so it's limiting what I'm presenting. Let me get to presenting the entire screen. Oh, is it up?
A blank slide?
Yeah, a blank slide. Yeah. Okay, perfect. So I was talking about a player which has a minimum bid of 20 lakhs, right? So two teams jumped in and they took the player bid to 40 lakhs. Another team jumped in, took the player bid to 60 lakhs. Two more teams jumped in and took the player bid to 1 crore, and that is where the auction ended. I'm talking about the IPL auction for a player, right? Now, if we look at the trajectory of the price, right, from 20, 40, 60, 1 crore, can I say that if the price has an upward momentum or if has an upward movement, there is an implied underlying demand to it? If there would have been no demand for the player, would the price ever go from 20 lakhs to 1 crore? It's impossible, right? Similarly, let's take an example of mango, since it's the season and everybody's relishing it. Let's say I think in February or March they come for maybe 2,000 rupees a dozen, right? So 2,000 rupees a dozen, that's where they come in February. Now, as soon as the supply starts to kick in March, April, this price starts to go down 1,500, 1,200, 1,000. Why does that happen? Because more and more supply is coming into the market. So can I say that if the price is in a downward trajectory, there is excess supply or supply is more than demand in the market? Definitely, right? If there would have been limited supply or the supply wouldn't have come, the price would have stayed around the same range, provided the demand is constant. Right? So clearly price is in itself telling you about the underlying demand and supply factors, which exactly what technical analysis is trying to work with. So when I say that price came from X to X minus 5, I'm kind of thinking that, okay, that's something that there's underlying supply to it, which is driving the price down. Right? And on the contrary, if the price is on an upward trajectory, and if I see that all factors being constant, there's an implied underlying demand to it. Right? So let's say that if there would have been a equilibrium between demand and supply, so you have 100 dozens of mango being supplied for every 100 dozens of demand, do you think that the price would go anywhere? No, right? The price would be stagnant because neither the buyer nor the seller has an incentive to make any change. So technical analysis helps us understand from its patterns or from its teachings that who is in control. Is the buyer in the control of the price, or is the seller in control of the price? Because if the buyer is in control, the price is going to show an upward trajectory, and if the price is in a declining scenario, then the seller is in control, which evidences its downward trajectory. Let's say you are an investor, okay? So you invest at 100 rupees. Now you might invest into a company which is out of this world, which has an excellent future, which has done its capex, has some excess capacity, and there's a good chance that the capacity would be utilized. Unless there's demand to the stock, how would the price go up? Which means that there's a kind of a myth that technical analysis, oh, it kind of, overpowers fundamental, or fundamental analysis is kind of irrelevant in today's world, or just fundamental analysis is important. Either of these scenarios are not true. Fundamental analysis might tell you that, as I said, there is excess capacity, the capex cycle is done, and the company is ready to reap the top line growth. But till the time there is evidence from the technical analysis perspective about the demand in the price of the stock, technically the stock is not going to move. So that is the reason why technical analysis works, because, as I said, it's underlying linked to demand and supply. And if I go back to this auction example, the mango and the IPL auction example, when IPL teams were jumping in to buy the player, there was an underlying greed to have that player on board, right? And when mango prices were falling down, there was a fear among the farmers that what would I do with these excess mangoes? They would ultimately have to be thrown away, right? So there is kind of a greed that sits on the buyer side, on the demand side, and there's kind of a fear that sits on the seller side. So the underlying emotions that drive demand and supply are greed and fear, and these emotions are human emotions that have been fortunately or unfortunately constant over decades, or rather centuries, and which is why the patterns that were instituted hundreds of years ago are still relevant from technical analysis point of view. This is the point that I was trying to make. Now there's a very common term which is called as Bhav Bhagwan. Technical analysis is exactly trying to say that if the price is showing an upward trajectory, I know that there is demand. So price is God, in the sense that I do not need to look beyond price. If I am a buyer, I'm convinced that if there's underlying demand to the price, that's it. That's what I'm looking for. So price tells you everything. That's what technical analysis works on. And because, to sum it up, because it reflects the human emotions of fear and greed, like, just for fun, let me share the Great Depression charts for the S&P 500. This is right from 1929. So you would see that although we haven't talked about the specifics, right? We are just we have just started, and we're just talking about the basics. So if you go all the way back, you'll see that there's a kind of similar structure just to the naked eye, that you would be able to see this kind of similar structure. You'll see that whenever, this is from where the price is going down, when this level is crossed, it gets some momentum. Then this is a trend that is being followed. So just looking at it from a layman point of view, it's able to tell you so many things. And this is from the 1960s, or rather even before that, 1929. Every pattern is kind of similar and repeatable. That's the beauty and kind of an underlying assumption of technical analysis, that the patterns are expected to repeat. Coming to some of the myths and info about technical analysis, before I go to the building blocks, I really want to talk about this, because what happens is, when we say we, I mean the society, we tend to have a lot of taboo around certain things. Like stock market was considered a taboo. Like, I mean, oh, that's something that where people lose money. Oh, that's something which is pure gambling. But nobody thought about that. If you use a non-methodical approach on, say, on a machine which does some heavy duty work, and somebody gets injured, do you blame the machine for it, or do you blame the lack of methodical approach? Same has been the case with stock markets. Nobody thought that, oh, there has never been an effort to put in methodical approach or a recurring approach to trading the markets or to investing in the markets, everybody just blames at the outcome. Nobody is looking at what's wrong with the approach that is being adopted to the market. So I really want to clarify some of the myths here. There's just one info which I have mentioned here, which is about the Charles Dow. He's considered as the father of technical analysis, and I'll talk about the Dow theory in a while. But he's the one who really kind of instituted the concepts of technical analysis in his publications. That was back in 19th century, right? So the point that I was referring to, that these concepts have aged well over time, they are indeed true. Now coming to the myth, right? That technical analysis is gambling. My counter is that if technical analysis is gambling, that then any method of forecasting which is in some way scientific and methodical is gambling. Then weather forecasting is gambling, isn't it? Because can the weather department forecast with 100% accuracy that it's going to rain between 6 to 6:30? Nobody can do that with 100% accuracy. They are trying to be reasonably accurate, and that's what we want. Like, even if the weather forecast is able to avoid 4 or 5 storms, that's a win-win for us, right? And similar is the case with technical analysis. It is a forecasting technique using historical patterns, which means it's based on probabilities and not certainties. So there's a lot of buzz about, especially for influencers these days, everywhere there's a lot of systems being sold, algorithms being sold. um, Unfortunately, due to my work obligations, I'm not able to contribute uh, towards them in the right way. But uh, there are systems being sold which say that out of every 100 trades I placed, I got a 99% accuracy. I would say, if that's something someone is claiming, just take your money and run away. Because statistically it's not possible for a forecasting technique. It might happen on a smaller population. Like, out of 10 trades, I might say that I got 10 out of 10 correct. But as you increase the number of trades, it's not meant to be accurate. That's the point. It's simply a forecasting technique which is intended to give you high probability entry points and high probability setups. So again, clarifying that it's not concerned with high accuracy of trades. Like, if you analyze the performances of the best traders or even investors, their accuracy might be sitting somewhere around 35-40%, right? So it's more about when you lose, how much you lose, and when you win, how much you win, right? It's more about the quality of the trades or quality of stocks or quality of investments you make, rather than being accurate about the trades. It's something which is not relevant, right? Then there's another myth. So I think I would have clarified when I'm referring to investors here. There's a myth that technical analysis, oh, come on, that is something which is only useful for traders, high frequency traders, or maybe algorithmic traders, or intraday traders. Investors, okay, they do not have anything to benefit from it. I I would like to disagree here, because if I look from an investor's point of view, I'm talking about an investor who is an active investor. By the way, I'm not talking about an investor who invests into ETFs or exchange traded funds on a passive basis and forgets. Right? I'm not talking about that investor. I'm talking about an active investor who is churning their portfolio on a recurring basis, maybe every quarterly. Right? If you look at what that investor is trying to achieve, that investor is trying to achieve maximum return for a minimum risk. Now, isn't that something traders do? Yeah, trader is a term that is used for somebody who places trades on a very frequent basis. But if if a trader chooses to place trades on a quarterly basis, then technically would say that that person is an investor, and that person can very well use the techniques of technical analysis to make their investments better. So this tool is indeed useful for investors. And one more myth that exists is it's used only for stocks, right? Uh, in my kind of communication today, I might have reference to stock earlier, and I would continue to do that just from a simplicity perspective. But what I want to clearly clarify is that technical analysis is not meant for stocks only. It's meant for any series of data that can be plotted into charts. It can be used for commodities. Rather, that's where the maximum use is. Like, most of the traders who have made crazy money is in commodities, right? So be it interest rates, be it asset-backed securities, mortgage-backed security, just name anything that for which you can have a historical time series data, and you can apply the principles of technical analysis to it. One clarificatory point is that technical analysis, lot of people claim that it's quantitative trading. Quantitative trading is a different world altogether. Quantitative trading does not even look at charts. It looks more from a statistical point of view, more about statistical models and building buy and sell signals using those statistical models. So it's in a different sphere altogether. Although I would say that there are certain concepts which overlap about the use of averages, use of, I would say, regression, right? So certain concepts would overlap, but it's technical analysis is more about charting and making decisions based on the chart patterns rather than purely statistical models, right? And the last point which I want to make is something which can be a heartbreak for many, that it's claimed that technical analysis is the only thing that you need to build a profitable system. Uh, Unfortunately, that's not the case. Um, if I want to relate it to, say, Virat Kohli's batting, right? So technical analysis is the right technique to bat, right? But what if that technique is not rightly executed on the field, right? So trade execution and management is an important facet. What if he does not protect his wicket on a very tricky pitch, right? So risk management, like protecting your capital, is very important aspect. What if there's no right temperament on the field? Say it's expected to go hard within the power play, but that does not happen. So the psychology and discipline on the field. So technical analysis will just give you the right technique to do well in the markets, but all these things, trade execution, risk management, psychology, and discipline, are important pillars for the overall system to be accurate or to kind of fructify, if I want to say it that way. Which is the reason why you would see that there's a surge in use of algorithmic trading. Forget about the derivatives aspect of it, but even in case of investing, many tend to use algorithmic trading just because it helps reduce those biases of execution, risk management, psychology. uh, if somebody had a bias, let's say 8 months back, that PSU stocks, I'm not even going to touch them. Okay, no, they haven't done well for the investors, and it's very common for investors to have that bias based on what that sector has done. I mean, they would have missed out on crazy amount of returns that stocks have given in the last 8 to 12 months. So these biases, which are part of psychology, managing risk, which I'll talk about in the next slide, uh, trade execution, these all are important aspects of your overall system. So those also need to be kept in mind. Sorry, somebody had a question.
If there are any questions, you can post in chat box. Sarika can ask them. You may proceed.
Yeah.
Sure. Okay. Sure. I would now like to come to the building blocks of technical analysis. And as I said earlier, I would like to explain the building blocks for our trading system, right? Just to summarize all of the things that we discussed till now. What is technical analysis? We spoke about it being a forecasting technique, which is based on probability and not certainty. We spoke about why it works. It works because it has underlying principles of demand and supply, which are further triggered by greed and fear. And these emotions have been constant over centuries. We spoke about some of the myths, and I think I need not repeat the myths because those are clear. And with this, we'll now move to the next step, that is building blocks of technical analysis. Now, let's say we want to build a system. A trading system is simply a rule-based system which tells you when to buy and when to sell. Okay. Now, before even we go to chart or even go to chart patterns, rather, we need to understand what exactly happened in the market for a particular period we are looking at. Now, let me again come back to the example I was mentioning about the auction, right? So let me have a fresh slide here. So as I said, the market is just like a giant auction, right? So every day buyers and sellers will wrestle to push the price in either direction. So let's say the price started at 100 rupees. Okay, the price opened at 100 rupees. During the day it went to 150 rupees. Okay, and this is where some of the sellers that were sitting, so they sold heavily and they pushed the price down all the way back to 95 rupees. And from 95 there were certain buyers who were sitting here, so they again pushed the price to 99, which is where the day closed, right? So we are looking at the action from a day's point of view, right? So what I said, a stock opened at 100, so this is my open. The stock went to 150, so this is my high of the day. The stock went all the way up to 95, so this is my low of the day, and it finally closed at 99, so this is my close of the day, right? So there's this aspect which looks at what was the action during the day in terms of open, high, low, and close. Now let's say I'm not interested in high, low, and open. I'm just interested in where the close is. So let's say it closed at 99 here. Next day it closed at 101. Next day it closed at 103. The day after it closed at 100, or rather 101. And if I plot these data points and connect by a line, I get one chart type. So the chart type which just plots the closing prices in general. I mean, there are multiple iterations of chart types. I'm just trying to explain what are the commonly used chart types and what is used in general. So if I plot all the closes for a particular day and I draw a line through them, what I get is the line chart. So the chart that you're seeing right now is basically a line chart. So every data point on this chart is the close for what period. The period is mentioned here. So this is the weekly. So if I'm looking at the action on a weekly basis, this will be called a weekly chart. If I want to look at the closes on a daily basis, I can go and select day, and then what I'll have, I think we went right back into history, so we'll have to move up. So if I select day here, that means is every data point is basically the daily data point. So that's where we call a daily chart. So you have the daily, you have the weekly. If somebody is an investor, right, I would not want to look at what's happening on a daily and weekly basis. I would say, just tell me what's happening on a monthly basis. I would say, okay, I'll go to month. So each data point here belongs to that particular month. So each data point here belongs to the close of that particular month, which is why we call this as a monthly chart, right? So the monthly, the weekly, the daily, these are the time frames that are technically called in technical analysis. So if somebody says I'm looking at the daily time frame, which means that they are looking at daily data points on the chart, right? And this is the line chart. The one that I showed you on this side, this one, this is called a bar chart. And if I draw a body between the open and close, like just a variation, like, and that body is usually shaded depending on where the open and close is, this is called a candlestick, right? So in a candle, so candlestick is called a kind of a Japanese candlestick pattern, which means it gives you four variables: open, high, low, close. And because it gives you all these variables for that period, it's something which is kind of widely used in technical analysis. So if I go to the candles, you'll see this, see the point that I was making. So let's look at this candle here, right? So the time frame is daily, which means that this candle represents the daily action for S&P 500. Now, this is the high, this is the low, right? This is the open, and this is the close. Now, if you look at this candle, right? So how would I know whether this is the open? This is not great, I think, in terms of writing text, but fine. What I was trying to say, how would you know that whether this is the open or this is the open? That's something that you would able to understand by looking at the color of the chart, right? Color of the bar rather. If the close of the market was higher than the opening, it means the close will be on the upper side. And let's take a look at this bar. Now, how do you know whether this is the open or this is the open? Since this is a red bar, it means that the market closed below its open, which means this becomes your open and this becomes your close. So it's like saying that when the auction started, when the market started, the price was this, but there was selling during the period, which is why the price closed here, which means that the sellers are in control, which is why it's kind of represented red to kind of denote who is in control for that particular session, right? And again, the highs and the lows that are represented by these lines, they are technically called as wicks. Okay, so this is called the wick of the candle. The distance between the open and close is called the body of the candle. Now, why this is important is that there are many chart patterns just around this, right? Because I said technical analysis is about understanding who is in control. Let's say, let's talk about this candle here. So if you look at this candle, right, this candle is kind of engulfing. I do not want to go into technicalities, but a strong kind of seller candle, right? Because it opened here, it closed here, right? So it kind of shows that the sellers were in control. But there's a kind of analogy to it, that if the high of this candle is taken out, right? So there were sellers here, right? Which is why the price came down. Now, when this high will be taken out, there's an assumption that the demand will kind of overtake the supply, right? So, which is why these candlesticks by themselves, you know, do provide a lot of kind of information, but it requires really that kind of detailed price action analysis to it. I just wanted to explain the intricacies around the candlesticks in isolation, right? So again, like you had a seller candle here, which means sellers are present at this level, right? So somebody would say that unless this level is breached, I'm not going to take a fresh buy. On TV, you would be seeing a lot of analysis talking, right? Like unless 5,000, I would be buying on, I would be a buyer above 5,350. Why do they say that? Because the price went here and it gave a kind of a heavy selling candle here, right? So that's how candlesticks are used to assess. But as I said, you just cannot go in the market and just place trades on the basis of just candlesticks. A lot of things need to be put together in order for the trade execution to be in place. But this is the reason why they provide very beautiful insights about what exactly happened during the trading day, right? So that's about the candlesticks pattern. Now, I spoke about the bar chart. I spoke about the candlesticks. I spoke about the candlestick being a variation of bar chart. Now, these are the primary chart types. If you go to TradingView, if you're not a TradingView user, if you're very new to technical analysis, I would suggest that you can start using TradingView. I'm not endorsing them because I get something. It's just that it's very user friendly. There's a lot of new things to add and play around with. Currently, they just provide 2 free indicators, but I think it's a very good kind of tool to get started with, right? So if you want to just look at the different chart types, there are n number of chart types like Heiken-Ishi, Renko, line break, volume candles, area, like just name it, and there are different types of chart candles. But the primary used chart type is Japanese candlesticks, which you're seeing on your screen right now, right? So that's about the chart types. Now coming to the next point. Yeah. So ideally, I would have loved to talk about the different chart patterns, like engulfing. I was mentioning about, you have a harami candle, you have head and shoulders, different patterns that are used using these candlesticks. Due to paucity of time, I would not be able to disclose the chart patterns in detail. So I would suggest a book which is called as Technical Analysis of Stock Trends by Edwards and Maggie. This was written early in the early 20th century, and it's a fantastic read to just understand the different technical analysis patterns that exist and can be followed. So I would strongly recommend you to go through this book, Technical Analysis of Stock Trends by Edwards and Maggie. Okay, so coming to the next building block of technical analysis is understanding market trends. Okay, let me go back to our markets. Enough of S&Ps. we are we are likely going to be the leader in the next decade or so. So let's stick to our markets. So I'm presenting the stock for which I was showing you the data in table. So this is Trent, um, a stock which has risen almost by 4x, I think, in the last 12 months or so. Now, what I want to explain is uh, another fundamental concept about understanding trends and cycles. Now, even before I talk about trend, I want to go back to this presentation, and I would like to say, okay, let's say, sorry, this PPT thing is a bit fidgety. Okay, so I'll have to figure out. Okay, yeah. So let's say we started here. So a stock started at 100. Now let's understand who are the participants in the market, right? We have a hedge fund, we have a short-term investor, we have a long-term investor, we have a trader, we have a institution like LIC who is kind of buying for the long term, and then we have corporations, right? Now each of these participant has a different objective in the market, right? The reason I'm explaining is to understand why the price moves the way it does in the markets, right? So each of these participant has a different mindset. The hedge fund is not interested to sit for 4 or 5 months. He's like, okay, well, I got my 10-12% on leverage. I'm just taking my money, I'm going out, right? You might have a high frequency trader who is even not looking to stay more than a minute or more than maybe 5 minutes, right? So different market participants make up the markets. What happens is, let's say all of them entered into the stock at 100. What will happen is the demand will push the price to 120. Fine. Now the participants who are looking for 20% profit, right, or the participants who are short-term oriented, what they'll do is they'll square off. So when they'll start selling here, what will happen is the price will come down to 115. Now, out of these participants, the ones who wouldn't have entered at 100, they will see, oh, the price came from 120 to 115. Let me buy at 115. So they'll enter at 115 and they'll again push the price higher to 140. Now, again, somebody who has bought at 100 and who is a kind of a swing trader will say, oh, 40%. Okay, I think that's what I was looking for. I think my risk is covered. I'm going to book my profits. So again, you'll have a bout of selling in the markets. So that will take the price to 130. Now, again, the people who couldn't enter here, they'll again jump. They'll say, okay, the stock has increased 40% in 2 months, and it's fallen roughly 8%, or rather 7%, right? So they'll jump in at 130 and they'll take the price higher to 160. The point that I'm trying to tell you is that this is the trend which Charles Dow talked about in his Dow theory about an uptrend. So whenever there is an uptrend in a particular stock, so this 115, this 130, these are called as higher lows. This 120, this 140, and this 160. These are called as higher highs. Why higher highs? Because each high is higher than the earlier high. Why higher low? Because each low is higher than the previous low. So what Charles Dow said is that if there is an inherent strength in a particular pattern, that pattern will continue to do a higher high and a higher low pattern, because it's exactly mirroring what the underlying participants are trying to do. So it kind of exhibits a clear cut demand for that particular stock in this case. And on the contrary, how a downfall would be, okay, so we start from 100, sold at it came at 90. Somebody who is looking to buy here, they bought at here, it pushed to 95. Now the sellers will come in aggressively here because they couldn't sell at 100. Now it will go again to 85, right? So if buyers are in control, if buyer or if demand is exceeding supply, what Charles Dow said is that the price will always exhibit this trend. And this is the reason why stocks do not move in a straight line, because of the different participants that have different interest when they participate in the market, right? So this is the kind of the primary trend which needs to be looked at. One more important aspect which Charles Dow mentioned is about the different stages of a stock. So let's say what he said is, let's say a stock started here, right? Now this is the phase where there's not much action happening in the stock. It's just, lying in a no attention zone, like, it's not going down, but it's not even going up, right? Now what's happening here is, this is the stage one, which is kind of the accumulation phase. So he says, okay, this is where there's slow and steady accumulation that's happening. Now what happens is, there's a sudden dramatic rise in stock, right? It breaks the kind of lethargic range that it's kind of maintaining, and you see a sudden shoot up in the stock price. And what he says is that when this shoot up happens, people who are not noticing here they start noticing here. So the accumulation that was happening here, right? So why did the price shoot up? Because the supply got fully absorbed, right? So remember the point that we were talking earlier, when demand is exceeding supply, the price will tend to move up, just like the IPL auction. So as the price tends to move higher, this is because the supply got fully absorbed. And now what will happen is, this is caused by institutions. When I say institutional investors, right? Now this will again stick around. Now it has started attracting attention because it was not doing anything, and suddenly within a month it's given 30%, right? So it will attract trend followers, it will attract institutions like hedge funds, it will attract swing traders. So basically the initial push, and even, I mean, it's not that institutions will be done buying just in the first tranche. Like, if you look at it from the institution's point of view, they buy in a quantity which can technically move, which rather not can technically, which technically moves the market, right? So it's not that they'll be done buying just in this first tranche. They'll also be adding to their buying in the up move. So lot of different participants jump on the train, which causes the price to move further higher, where it'll kind of again consolidate, and again the last move will be kind of a parabolic, or I would say exaggeration move, where the price will increase as if there is no tomorrow, right? And this increase is driven by FOMO buyers, like the one who saw the price rising and they were sitting on the sidelines, ki ab girega, ab girega, ab girega, ab girega, and they finally couldn't enter. And now when they saw some kind of pause, they jumped onto the trade, right? So the last phase of the rally is caused by the FOMO buyers, and this is where all the institutions who have been buying here, or all the like, traders who have been buying here, they'll dump their stock here. And when they dump their stock here, what will happen is these FOMO traders will be reluctant to kind of get off, or will be still buying. That supply will cause the stock to again enter into consolidation before it starts its downward trajectory. So this is stage one, this is stage two, right? This phase is stage three, where it's kind of, I'm naming HDFC Bank just because of its past performance. It's like HDFC Bank, it's like everybody has bought in, right? So everybody's expecting that the stock should give 15-20% higher, 20% higher, but nobody saw that stage two, almost everybody had participated in stage two, right? Now it's a different story, that 5 years the stock hasn't given any return, and it's again in kind of in that consolidated phase. So the point is that when everybody owns what's expected to own, then that momentum to push the price higher is lacking, right? So you had a stage one where it's kind of lethargic zone, you had the stage two, which is kind of um, action packed zone. The stage three is again kind of replica of stage one, it's just at the upper end of the channel. And when the supply will kind of exceed the demand, the stock will kind of go into the downtrend. Now this is the stage analysis which Charles Dow talked about. Now one needs to understand that not every stock will have a dramatic stage four, right? Because stage four needs to be accompanied with weakening fundamentals too. But if ever a stock enters into a stage four, then whether you are an investor, whether you are a trader, whether you are you have promised that you'll have this stock right till your future generations, it's a clear sign to get out. Because understand that if institutions are dumping the stock, it's not because they want you to buy it at a cheaper price, it's because there's not much steam left in that stock, right? Or in that story. So you need to be cautious about stocks who fall from stage 3 to stage 4. Just it makes sense to get out. Now there might be a common question as to how do you identify this, right? It's something that if I go to line chart for simplicity, and these stage analysis are usually done on higher time frames. So remember I talked about the weekly, the monthly. So when you are analyzing a stock, right, you are basically trying to understand which phase it sits in, right? So usually that's done at a very higher time frame, because the higher time frames is where the institutions are mostly active. So the quarterly, in this case I have quarterly or monthly, that's where institutions are active for the rebalancing or for the trading purposes. Now this is trend, right? Now this is a classic kind of stage one where the stock is virtually doing nothing, right? It's virtually kind of just languishing around here and there. And you notice this up move, right? So it went from 144 to kind of 320. Now here is the thing about technical analysis. Now many of you might say that, oh, but we wouldn't have any clue about this stock at 140, 150. Technical analysis is not meant to capture 100% of the price move from 170 to 4500. It's not meant for it, and rather nobody would be able to do it, right? What it's trying to help us with, analyze where there is demand, right? So if you think that, oh, I should be buying from 130 and I should get out exactly where the top is made, that's just on paper or just fictitious stuff that somebody's talking about. Technically nobody is able to do it, virtually nobody, right? It might happen by fluke, but then that's a different case altogether. We are talking about repetitive trading patterns here, right? So we'll we'll kind of wait for the stock to show kind of this move where it gets out of kind of this trading zone. And now you see that as soon as the stock enters into stage 2, the kind of parabolic move it sees, right? So that's the institutions first moving in, then you have the parabolic phase here. I think this is kind of the parabolic phase. But the idea here is that you do not want to enter here, right? You want to enter somewhere in the stage 2 of the stock, where the stock is like already given 80-90% return. Now this might sound odd, or that, how do you enter a stock which has already increased 80%? This is exactly the reason why many are not able to practice technical analysis, because it does not focus on fallen down stocks. Rather, it focuses on stocks which have exhibited that momentum or have exhibited that growth. So if a stock is up 80%, rather than being fearful about the stock will fall, oh, the stock has gone 80%, now it's going to fall. Why can't we think that if a stock has risen 80%, it might be on to a very bigger journey, right? So the stock went from 130 to 330 here, right? But if we would have said, oh, that's a 200% rise, forget it, the stock is going to fall down. Somebody would have missed the 380 to 4500 move, right? So the point is, when you are assessing your stocks or your mutual funds, right, always try to make sure that you are participating in the stage 2. I was talking about, uh, I'll come to HDFC Bank. What I was talking about Bajaj Finance earlier. Bajaj Finance is a classic case. I was looking at it earlier. So you had this kind of stage 1, then you had this kind of nice stage 2. This is a kind of stage 3, but I would not say a stage 3, because you have underlying growth to it. So stage 3 is, can be confirmed only when there's a breakdown, right? So if as Bajaj Finance kind of breaks here, let me kind of clear the drawing mess and so that it's more legible to you. What I'm trying to say here is, this is the this is the higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. The pattern continues right till this pattern was broken here, and since then it tried crossing this high, but it kind of failed and it came back in. So till the time this kind of structure is broken, it's not a confirmed stage 4. So it can very well happen that it does some time pass in the zone, and then it's again kind of shoots up. But the point here is that what I think is critical is that when you're looking at your return on investment, your return has two facets. One is your price, and second is your time. So if a stock is kind of stuck in a zone where it's kind of underperforming the market, or it's kind of stuck in a zone, it makes sense to look for other opportunities, right? Just because this has been a great journey, great stock, I mean, there are always entry opportunities that the stock will give you, but the real essence is to be with the trend where there is stage 2. So majority of the traders, investors who have made super normal profits, they have made in stage 2. Now just look at how beautiful the stage 2 of Bajaj Finance was. It was like right from 330 to 7,000. So this was entire stage 2. So you want to be in a phase, when you look at the market structure of your investments, you want to be in a phase where you are in the stage 2 and not stage 3 and not stage 4. Stage 3 to some extent is fine, because you will be able to know that the stock is kind of languishing only after it has spent some time there, right? So stage 3 to some extent is still fine, right? Because nobody can exactly tell that now this is stage 3, right? You'll only get to know that, okay, if the market has gone up 15% but the stock is just doing nothing, right, then it's kind of signs that it's kind of in a stage 3 or not doing anything. But you definitely don't want to be in a stage 4, and for a stage 4, as I said, you need to have weakening fundamentals. One of the classic examples that I look at is Yes Bank, right? So you had this kind of phase where this is, I would call, kind of a stage 1 where it gave a failed breakdown here. It then went into the stage 2, and it had a momental stage 3 before this massive decline. Now the point that I'm trying to tell is, if you were an investor in Yes Bank, you should have got out here 300, 290, whatsoever. Your thought process might be that, like, what I've seen is there's a mentality or there's an attitude to not get away with losing stocks, because we have that, okay, what if it comes up, right? So that can be addressed by a re-entry technique, right? If if that can very well happen that you exit and the stock again comes back to the level or crosses the previous high. If that happens, the technical analysis will help you re-enter into the stock. But you do not want to be into a stock which is, beating going down 30%, 20%. That's something which clearly tells you that institutions are not interested in the stock. And if there is no institutional demand, however great that company might be, the stock is never going to go up, right? So I think if this is the kind of takeaway I'm able to impart, that um, just be okay to get away with your losing stocks, but you need to be very sure of the stage they are in. Like, it's if it's in a stage 2 and you see a stock coming back, ideally that's an entry opportunity, which we'll talk about later, right? But if you see like 20-30% decline, and not seeing a meaningful recovery, it's okay to get off that stock, right? And look for a re-entry later, however emotionally connected you might be. First place, it's not viable from a PNL perspective to be emotionally connected, but many people have that tendency, which is stalking, right? So this is the most important aspect, having the right structure and participating in the right structure. Now, one more important thing which I want to talk about is you need to understand about so this is the structure which I said usually is assessed on larger time frames, which is monthly, 3 monthly. But what's important is um, for you to do your own technical analysis, right? uh, you need to look at yourself and ask yourself a question, that how much time I'm able to give to the markets, right? So this is just for analyzing the structure. But if I'm a person who is not able to give sufficient time to the markets, and I'm only looking at weekly or monthly buys and sells, then you can very well just look at the weekly and the monthly charts, right? But be sure of yourself that how much time you're able to give, because one of the major reasons why technical analysis is not successfully adopted is because if there are 10 signals, right, uh, 10 places where you should have bought, what happens is 3 places somebody is able to buy, 4 places they are like, oh, I got into some work and I missed that entry signal, and that entry signal could be the one that makes up the profit for all the entry signals. So when you sit down and build your own trading systems, look at the time frame that's suitable to you. Okay, weekly, okay, I can place trades on a kind of by analyzing the weekly charts. Weekly is something which is more feasible to me. Or somebody might say weekly, oh, I don't have that time every weekend, I'll just look at monthly charts, right? So stick to a time frame that suits you for your execution, and stick to it is the bottom line which I'm trying to make. um, Now, we spoke about the market structure, which is the most important aspect, that you want to be in the stage 2, you want to be in a structure on a longer time frame, which is kind of giving you that higher highs and higher lows. Now, coming back to trend, right? Even though you have identified the market structure right, oh, this is a mess. Let me clear. Okay. So even though we have identified the structure right, this still looks very ambiguous, right? I mean, okay, I see that from a higher time frame perspective, it's into that kind of, it has broken the previous high, which means that there's demand. It's made a higher low, it again is trying to move up. But where exactly do I say that, okay, this is the trend for me? Like, if the price comes below this, I'm going to pack my bags, take my money off the table and run, right? So structure is just the fundamental base. Now, second thing is defining a trend, right? Now, how can the trend be defined? Now, let's say I'm a person who is flexible looking at the weekly charts, because I feel that I can place my trades based on the signals given by weekly charts, right? So uh, defining a trend, or rather measuring a trend on a quantitative basis, there are many tools available in technical analysis to do it, that how you can measure a trend. There's one which talks about different indicators, but one of the most commonly used, I'm going to talk about it, is moving average, right? So I'm going to plot moving average exponential. So there are different types of moving averages. The book that I spoke about Edwards and Maggie, that will talk about the different moving averages, but exponential moving average is something which is kind of used commonly, so I'm going to stick to it. So what I've done is I've plotted the 50. You see the 50 here, right? So EMA 50 close, which means it's a moving average based on the 50 weekly data points. Why weekly? Because the time frame is weekly, right? So I've plotted a weekly average here, 50 weekly average. Why 50? Because 50 weekly average is something which is commonly followed across different investors. So uh, in technical analysis, right, it's kind of the opposite, that normally our tendency is to do something which is apart, like distinct from the crowd. But if many people are tracking this 50 period moving average, you will see that there's a tendency of the price to kind of come here in and bounce, come here, it went slightly below it and bounce, come here slightly below it and bounce, right? So rather, when many people look at a particular average, it kind of tends to exhibit that behavior, because many people are actively tracking this particular average. So which is why I've used a simple 50 period average. Now if we look at this average, right, so let's say we spoke about the stage 2 starting somewhere 100% or 200% above, somewhere around this maybe 300 mark, right? Right, this is where we can say maybe 100%, 150% above the lows. Now if you see, you'll notice that from 350 to 4500, the stock has been able to capture almost entire move above the 50 period moving average, right? Now this is just an observation, right? So what we did first, we said, okay, we want to look at stocks which are in stage 2. How we did that? By looking at stocks which are showing some rapid moves. We can do that using filters like charting. Secondly, we said, okay, for us, like uh, in this scenario, we are using a 50 period moving average because I'm trying to explain how a system is built, right? Many people play iterations with it. They'll say, I'll test 50 period, I'll test 49, I'll test 51, I'll test 45, I'll test 55, and I'll see wherever the point where, you know, it gives me the best results, right? So they'll test this with multiple stocks, but for convenience and since it's widely used, I'm saying, okay, let's stick to 50. Now what this 50 period is helping us is with is it's kind of giving us a definitive measure of the trend. It also gave us a measure that, okay, more than, I think, almost entire move was captured above the kind of the 50 period, except for the fall, these drops below this, these drops below this, these points below this, right? So we notice this. Now what can be done is we say, I'm going to buy above the weekly 50 period average, right? And what I'm going to do is that if I buy here, I'm not going to exit till, let's say, the price closed 1200 when the 50 period is 1260. So till the price crosses less than 5% of my 50 period average, I'm not going to exit. So that essentially covers us for, you know, a kind of false moves like this. So these moves are actually false moves, right? So somebody tried to push the price higher, but the buyer patiently waited till here to push the price up. So we said we are going to buy, but we are not going to exit till the price falls more than 5% below the 50 period average. And we suddenly have a kind of a trading system, right? So my point is, to start with, you can use a 50 period moving average to assess. Now there might be concerns about when to exit, right? So get into the stock. Should you wait till the price actually closes below the 50 period moving average? Now there might be a question, because if somebody has entered here 480 and somebody is sitting here 4500, why should I wait for the price to go below 3200, right? So many many kind of chartists use a second moving average, but that complexity is something which I will not like to add upon right now. So there's a concept of adding another technical another moving average to uh, kind of act like a trailing stop loss, right? So when you say trailing stop loss, that when the shorter term moving average kind of inverts or when the price closes below the shorter term moving average, people tend to book at least 50%, because exit is something which nobody can time with certainty that this is where the price is going to reverse. But to start with building a basic trading system, and if you're an investor, you can very well start with a 50 period moving average. Let's see what it did with Bajaj Finance. Right. So I was talking about the stage two, like even you see for stage two, right? So even for Bajaj Finance, it like majority of the stage two move came below the 50 period moving average, right? So my point is that start with a 50 period moving average to determine a trend, right? Build some of the techniques so that you can avoid false breakouts, false moves, or after a certain point. That's something which is not possible. If you get a false move, right? Somebody got a false move here, it's fine. If the price came back up, you can always re-enter, right? Or a more methodical approach would be to again re-enter when the highs are crossed, right? So build to identify the trend, build a kind of a system as to when to exit, say 5% below 50 moving average. Or if your stock has given substantial returns, then you can add a lower period moving average. So when I say lower period moving average, we added 50 here, you can have a 10 period to exit 50%, and then you can have a re-entry strategy in case that exit is kind of false and the stock kind of bounces back. So that's how kind of a trading system can be built, and it can be followed for stocks over stocks. If somebody says, no, I don't want to look at weekly, I want to look at monthly, right? So you can go to monthly and just do the same thing. You can use a 50, or you can use maybe a lesser period moving average. So let's say I look at HDFC Bank. There's a lot of talk about HDFC Bank not doing well. So if you notice here, right, so right from 2005, right, it's like, again, these are false moves. Majority of the move has been above the monthly 50 period, right? So it can tell you that if a stock is in a kind of a perma bull run, it's above the monthly. And if it's in a stage two, which you saw for Bajaj Finance, even I think HDFC Bank would represent the same characteristic. If it's in a stage two, you would be able to get majority of the moves. You would have got some whipsaws here, but you would be able to capture majority of the moves above the 50 period moving average. So that's how simple a trading system can be. Many think that it's very complicated, it's nuanced, it has a lot of different things, but following simple things on longer time frames do work, is the point I'm trying to make. So the structure, the trend, moving average is the one that I talked about. There are, of course, like RSI, Bollinger Bands. Trust me, I mean, we are not even covering the tip of the iceberg. Like if I want to talk about how RSI can do this, how Bollinger Bands can do this, how trend lines can do it, it'll be fun, but that's something which will take a long time, which something we can plan in the coming sessions. But the point is that you can use moving average coupled with RSI, right? So majority of the professional traders do not use just one tool. They use both tools in tandem with each other, coupled with understanding of support and resistance. So the structure that I was talking about here, right? The market structure, sorry, I was talking about here. So this 120, 115, 140. So the price where this 120, where the stock has exhibited some selling, this is technically called as resistance, right? It's simple. And the price from where the stock has shown a demand is called a support, right? Now the reason many people look at support and resistance is that in an uptrend, right, they do not want, as I said, right, the higher lows, they do not want to hold aggressive positions if a low is broken, right? Because it might be the case that if the lows are broken, that then there's a chance of a trend, right? So what people do is, again, this is something which is not like, say, science, that you need to reduce 20% positions when a low comes in. You need to iterate around the market sentiments, right? But what I'm trying to tell you is that the way these concepts can be used is that if you want to say re-enter, right? Say suppose this gave you a false breakdown and you want to re-enter. Ideal entry point would be on the break of the resistance, because that's more of a convincing entry which indicates that the supply has been taken over, right? Or even here, like HDFC broke down here, ideal entry would be sorry, this is I'm not sure what it's indicating. Oh, I think I opened the the American Depository Receipt. I think HDFC. So it's also trades on the New York Stock Exchange, which is why it's showing you the price in dollars. So that was the $70. So yeah, I was talking about this beast here. So like ideally now it's crossing the 50 period moving average, but would you directly jump and buy? That's where somebody would couple it with the knowledge of technical analysis, that if it has seen selling here, somebody would wait for the price to go above 1560, right? So you use some deterministic factors to say this is my trend. So 50 period moving average can be your trend, right? So this decides your trend. You're not going to buy below the 50 period moving average at all, but just because it's gone above the 50 period moving average, that's also something you'll have to fine tune, is what I'm saying, by looking at supports and resistance, or by combining it with either a different indicator or a slower period moving average. In this case, I coupled it with support and resistance, but that's something you will have to work on to find a fine tune a system. But um, the essence which I'm trying to cover is that it's not as difficult to kind of implement. It's just it needs consistent execution and some fine tuning to kind of make those meaningful decisions, and that needs to be done on a continual basis. I won't go around the details of support and resistance in paucity of time. I actually wanted to cover what are the different tools like Fibonacci and all. They are also used to understand where the possible support and possible resistance is. But in the paucity of time, I'll just give a quick walkthrough of them in terms of what they do, and I'll move forward. So what basically these tools are, they basically try to estimate where the possible support can be and possible resistance can be. I'm just talking about supports now because I'm talking in terms of uptrend, mostly from the investor's perspective. But Fibonacci is a tool that's kind of uh, let's say, so if somebody wants to see, okay, where would my trend change? So somebody would say that draw from one peak to another peak, and just buy above this 38.2 or maybe zero 0.5. So 0.5 is where there's a substantial change of trend, one would say. But even the levels like 0.32 and 61.8 can be covered. Apologies for not being able to cover in detail due to paucity of time, but I'll just to touch upon them. One more point which I wanted to cover, I know we are 1 minute over, but I'll still cover, is that uh, whenever a support is broken, right, it kind of becomes the next resistance because of this structure here. So assume that this support is broken, right? So sellers came down from 140 and the 115 support was broken. Now, till the time 115 is broken, it's not ideal to take another buy, because it shows that sellers were clearly in control, and there were no buyers at this zone, which was the reason why price fell below 115. So whenever a support is broken, wait for it to be again crossed before you kind of initiate um, a long trade. The last point which I want to confirm, which I want to to talk about or allude to before I go to the Q&A is, this is the holy grail in technical analysis about risk management. I mean, not much is talked about this, but as a DIY finance manager for yourself, please ensure that you know the risk well in advance before you enter into the markets. Like a 50% decline takes around 100% gain to make even make a break even. So risk is something which needs to be managed very clearly in the markets, and using systems like moving averages or RSI or even simple price action, you can find optimal points, like we just said, 50 period moving average, where your risk may be 5%, right? And you can enter with an expectation that the price will show an upward trajectory, right? Then position sizing management and exit, I wanted to cover some parts of it, but I'll give a pass through at this point of time. Summarizing the path, spoke about a lot of things. I'd like to just summarize or give the crux of what I said. How much time you can give, that decides your time frame. Understanding chart types, I would say stick to candlesticks. Understanding price action patterns, trend lines. You can start with simple moving averages and evolve through the different patterns and trend lines, and use these techniques in conjunction with each other, because you want more uh, probabilities in your favor, right? So use these techniques in conjunction with each other and not in isolation. About indicators, there are tons out there, but I feel RSI and Bollinger Bands should do the trick. What's your risk appetite? Are you somebody who is very sensitive to changes in price? Then you might stick to just MFs and equity. Similar analysis can be applied on MS as well for information. Establish a rule, like we said. We said 50. I just mentioned MA9 for monthly positions. Establish an exit point, like we said, 5% below the 50 period moving average, just to cover those kind of fake outs. Backtest it. We have a lot of backtesting software available, and just implement whatever gives you the best. It might be 52, 50, 49, but one or two here and there does not make a meaningful difference in the long term. And yeah, actually that's where I wanted to end, but I just jotted this down as I was closing this out, that what most kind of investors do who have achieved phenomenal returns is still first filter out the sectors based on fundamental analysis, that which sectors are likely to show bigger growth, which are rather already showing quarter-on-quarter growth, have a bigger total addressable market, which have capacity expansion, which can drive the top line growth. And within that sectors, what you can do is you can simply look at stocks which have done exceptionally well in the last 1 month. Just rank top 50 stocks and try to apply the technical analysis principles on this, and just kind of repeat. So this is just one idea which I wanted to give as I part ways, but that's it. It was an overwhelming experience to cover in 1.5 hours, but I hope I did a good job. And over to the anchor for any Q&As.
Hi, Archit.
Hi.
The anchor had to leave due to some emergencies, but then
Sure.
I'm there to read out the questions in the chat box.
Sure.
Basically, participants have given so many compliments for the session at the outset, so thank you so much for that. Someone is asking for to post the TA book name which you had shared.
Sure, I'll post it. It's technical analysis of.
Yeah, Edwards and Maggie. Thank you so much. Participants have also requested for your LinkedIn profile link if you are comfortable.
Sure, I can.
Another question is, how to identify the trend reversal?
Right. So trend reversal is something. Let me go back to the chart. So if I'm looking at my primary trend as my 50 period moving average, right? Any close below the 50 period moving average is clearly a trend reversal for me. So if I were trading this HDFC Bank, any close below this, or the 5% margin that we talked about, just to avoid any shakeouts, because there are false moves that as well. So I would be closing somewhere around here. So you need to decide what is your primary trend. But for aggressive positions, so when I say aggressive positions, that there are some professional traders who will take on leverage, right? Who will trade via futures. In that case, what they usually do is they'll they'll get off 50% of the positions whenever a previous support is breached. So let's say in this case, they'll not wait for the price to go here. What they'll simply do is, if I zoom in, right? What they'll do is they'll get out somewhere around here. So this is the kind of the point which drove the entire move, right? So the price came here and it bounced off from here. So any break below this low, they'll simply get off, right? So if you want to analyze a change of trend, analyze if you want to do it to get off your aggressive positions, take off your profits, or just get out of the primary trend. As I said, to summarize, use your primary trend signal to get out of your entire position. If you're holding anything, like no longs below 50 period moving average whatsoever, right? Get out of the swing. If you are aggressive, you can book 50% profits. And if you are very, very aggressive, then you can use a very short-term moving average. As I was saying earlier, you can use maybe a 9-period moving average. So if somebody would have used a 9-period moving average, which is commonly used for trailing stop losses, then that exit would have come somewhere here. So that change of trend is somewhere here, right? So, but this is for mostly aggressive traders. Somebody who is an investor, I wouldn't recommend using that kind of aggressive approach, just because you'll get a lot of whipsaws. I hope that answered your question.
Okay. The next question is, what is the difference between fundamental analysis and technical analysis?
Right. So let's say HDFC Bank, right? If you look at the quarterly numbers of HDFC Bank, let me just HDFC Bank screener, right? So right. So if we look at the results of HDFC Bank, or the kind of the guidance that the management has given, because fundamental analysis is not just about historical, it's about what is the bank expected to give. I mean, you had phenomenal growth after the HDFC merger, right? But if you look at where the kind of price is, it's kind of lower than what the price was at the time of the merger, right? So technically, with a very great outlook, with the management guiding for 15 to 18%, I think that's where they were guiding at. So fundamental analysis more of looks at it from the cash flows and the valuation point of view, that what's the price to book, whether it's expensive from the price to book. Like the price to book is, I think it's 519, so around 3-ish, right? So fundamental analysis looks more of from the cash flows and the book value and the trajectory of the earnings point of view, whereas technical analysis is mostly concerned with what the price is doing. Like, I do not know how much HDFC Bank made when the price shot from 364 to 1200. The only thing technical analysts would know is that there is underlying demand to HDFC Bank stock, and there's a good entry point to get here. So that's where the difference lies. Technical analysis is mostly concerned with the price only. It's not telling you anywhere about how much the earnings grew by, whether it's expensive or it's not expensive, where's the book value. So that's where the difference lies. But just to address your question fully, I think the beauty lies at the intersection of both of these analysis. Like fundamental will tell you, okay, where's my growth opportunity? Like what's coming next, right? Where can companies grow the top line? And clubbing that knowledge with technical analysis will help you to time that sector better. That's the point.
Thank you. Thank you so much. What is the capex cycle? Is next question.
So capex cycle is the capital expansion which companies do. So let's say Maruti Suzuki announced that in order to grow their top line, they are making, I think, upwards of lakh crore of investments. So why capex cycle is closely tracked, that's mostly tracked by fundamental analysts, I must admit, is because how would a company like Maruti increase its top line till the time it has more capacity? right? So the only way for a company like Maruti, Tata Motors, or a core manufacturing entity to increase its top line is either by substantial increase in capacity or rapid rise in prices, which is not feasible, which is why capex is the capital expansion that I was referring to, which is tracked for top line growth.
Let me take one or two questions. Still two questions are pending.
Sure.
So what is algorithmic trading?
Right. So algorithmic trading is something which, let me give you a glimpse of it. So simply the set of rules that you decide, right? You give it to a code, right? And you let the code do the job for you, instead of you going in and manually punching in the order or doing something. So let's say, um, let's look at this code, for example. So this is kind of a classical example of algorithmic trading. It's plotting the variables. In this case, this is the upper Bollinger Band, lower Bollinger Band, and it's giving the buy and the sell signals. Like if you see here, right, buy, it's a bit technical, but I'll just try to explain. So it's giving some conditions which are met, the buy signal needs to be triggered, and if some signals are met, sell needs to be triggered. So whatever trading system you build, that's just coded, and then the trades happen automatically. You need not bother about the execution aspect. So that's algorithmic trading.
Thank you. How to get support and support resistance in the weekly time frame?
Right. So support and resistance, again, it I would say that you use the 50 period moving average, because that's something which is very commonly used. Support and resistance, you can use the prior swing. So when I talked about swing earlier, it's the low from which the price has made a new high. Like if I want to look at what's the swing for this move, right, you can very well say that this is the swing, because this is the low from which the price has made the new high. So this is where ideally the price uh, should take support, but these are not kind of definitive levels ingrained on sand, is what I want to emphasize on. These depend on what your investing style is. So do not go at too much granularity. Just keep very simple, like a 50 period moving average or a longer time zone, just so that you be in the market for long.
How does AI like ChatGPT help in technical analysis and algo trading? And are you using any? Is next question.
ChatGPT can actually help very well in building the code. Like if you go to ChatGPT and if you ask for a code, a Python code, it'll help you give a very good code from where you can build on. Um, I um, I mean, I work for a fund which does that, so I do not I'm not like authorized to deploy this on my personal accounts because of confidentiality purposes. But I mean, prior to my current role, I was definitely doing it.
Thank you so much, Archit. We are really grateful to you for your valuable insights that you've shared, as well as the time on a Saturday evening. But I'm sure that all those who have invested this time on Saturday evening will definitely have a wonderful time ahead. And
I
I
hope so.
request Chitray sir also for his valedictory remarks. And thank you so much on behalf of all the participants as well as the entire organizing team here for your valuable time, Archit. Very soon, when you're next at Pune during your visit, we would like to host you here at the branch as well. Thank you so much. Over to you, Chitray sir, for
Thank
your
you.
valedictory remarks.
No, only one remark that you said those who have invested their Saturday evenings will reach harvest on Mondays.
Yes, of course.
Yeah.
Yeah.
And there was one comment also for next session, so maybe you can coordinate with him whenever he has time, and we can coordinate. Of course, whenever he comes in Pune, we can have a physical session. But even otherwise, if time permits, for both of us, for the branch and for him, we will have. Yeah.
We can have a series and sequels as well, considering the wonderful comments and compliments that we have got. So thank you so much. And thanks to Chitray sir for this wonderful
So
idea.
now there is fashion of technical analysis Technical analysis returns, you can understand.
Because the sequel would be the technical analysis
Yeah.
returns. Very well said. Thank you so much. I also take this opportunity to thank our coordinator Sarika, who had to leave in between due to some emergency, as well as the entire technical staff team for the support during the entire webinar. Thank you so much and good night to everyone. Thanks.
Thank
Thank you,
you.
Archit.
Thank you all.
Welcome.
Thank you. Bye
Yeah,
bye.
thank
Thank you. Bye.